purpose of this video is to help everyone understand how to strategically approach trading GME, GameStop, or AMC during this high period of volatility, should you wish to do so. These aren't securities that I'm specifically focused on trading or approaching simply because it's a hyper period of volatility and it's largely sentiment driven and the price action is somewhat erratic, but there are strategic elements to approaching trades on both and some cautions that I think everybody needs before engaging. So that's the purpose of this video. I recorded this portion for insider access, but I really wanted to make this public because I think there's a potential that a lot of people get involved, and if you don't understand some of the strategic elements involved and some of the risks and some of the things that you may want to know when approaching either one of these securities, it could be very dangerous. But if you do have a better understanding, I think you're in a much better place. So more just a matter of trying to help the community, trying to help retail traders understand what you're doing and approach it from a strategic standpoint. So here we are. So quickly, be very careful if you're trading. Note the heavy run-ups in after hours. We know that after hours does not have the same kind of volume. Price is more sensitive. So just a warning, if you're trading the underlying stock, which I would trade underlying if I was doing anything, and I would scalp intraday if I'm doing anything, know that it's not simply that price is sensitive. You can have a harder time getting fills. All else equal, there's less liquidity. It is harder to get fills. Some brokers do a very poor job of filling in the after hours. Be very careful. So one of the things that can get you into trouble is you set your stops or take profits in the after hours, it just blows right past it, and then you wake up and price isn't where you want it to be. So if I was working, I would do it intraday. Again, this is if you're looking to trade, not if you're looking to buy and hold. That's completely different. And then in terms of options, we talk about IV so frequently. Well, let's take a look at the options chain here. This is the Thinkorswim options chain, and same options chain we'll see anywhere. This is the options chain on GME. We're at 48.75, right? 48.75. Look at the prints for $3, $4, $5 out of the money. That's absurd. This is what we talk about when we talk about how IV can make an enormous difference. And I actually referenced before when explaining insiders, I said during the days when GME was making its run, GameStop, you saw explosive IVs that were absolutely absurd, right? This is absurd. To pay $11 per contract for something that's, $225 out of the money, $3 out of the money, $325 out of the money, $425, you're still paying $1,000, and the spreads make absolutely no sense. Difference of $1, an entire point, 5-cent difference. So $5 difference in contracts, $100 price point, seeing $1 on the underlying, it's bonkers, right? And then even the spreads in between. So I'm talking about the spreads between strikes and then the spreads between the actual on the actual contracts themselves. 11.65, not the worst, but it's pretty wide. So I don't like the idea of working with options here. Now, if you were writing options and you're willing to part with your shares, that's a little bit different because you can collect some really heavy premiums. I mean, if you could get away with a weekly and you're selling a weekly for $7.50, $6, I think that's from a risk to reward standpoint, this would just be an idea to any insiders holding. That's what you might want to decide on, because this is your day as an options writer. If you hold 100 shares, this is your moment where you could sell off. Now, I wouldn't recommend buying 100 shares, just if maybe you were a holder and you didn't want to do anything else with the shares and you wanted to hedge against them. You could look at writing some options and see if you could sell. Go really deep out of the money because the premiums are wild. But that's why I don't recommend, I don't like the idea rather of trading the options, because the premiums are absolutely wild and premiums can deflate rapidly. So not only would you have a fast underlying deflation if there's just less interest, that can deflate rapidly. The spreads are wild. It's hard to figure out liquidity, and then after hours can be a problem too. To me, if you're working with GME or AMC intraday and you're working with the underlying stock, AMC is a little bit better actually when you look at the options chain. I took a look. So if you have to go options or if you're really inclined to, you get a better bang for your buck with AMC to an extent, but percentage wise, that's still quite the move, right? Because it's $1.15 on a 685 underlying. That's a substantial move price wise, percentage wise, and you're still paying $1.61. That's a lot of extrinsic premium. Not as good of options for selling, although maybe, right? $12.50. There's a lot of action here. Dollar. That's would constitute an enormous move on the underlying. So just be cautious. And then when it comes to options chains, actually something I wanted to pull up. This is the day after where I'm finishing off this video. And I talked about how dangerous it was looking at these out of the money contracts because they're so inflated. Look at the absolute drop, right? So now if you're going 1 point out of the money, half a point out of the money, look at the value of the premiums. This is for GameStop, and that's over one night. So that is an enormous drop here. And that just underscores the volatility with trading options, particularly when the IV is so inflated. To see something where 1 point out of the money, you have a $6 premium or $6.40 premium and spreads this wide, it makes it very, very dangerous. And just for those of you who don't understand the concept of spreads, meaning if the bid is at 585 and the ask is say 630, right? For you to get filled, if you chase the ask and you hit, let's say 630, you're already out that much because the amount that you can get for your contract is what someone's willing to bid. So the problem with wide spreads is if you go in on the asking side, the best you can get is the bid. You start behind the ball. So just a little bit of a follow-up there, and I hope this video was informative and helpful for people. If nothing else, helps you understand the mechanics and some of the risks associated. All right, guys, trade smart, be well.